Thank you very much and good morning, everyone. I only have about 10 to 12 minutes today. I'm going to cover apartment fundamentals. I'm going to try and give you guys the Cliff Note style version of what's currently happening in our market. Usually we would cover apartment construction, but given the amount of construction we've already discussed today, I'm going to skip this slide and try and give everybody else some more time here. But basically, it sounds like Jerry said we're headed in a better direction in terms of apartment construction. We're still an undersupplied market, but we expect this rate of construction to increase in the coming years. Moving on to vacancies, this slide highlights the submarkets with the highest and lowest vacancies that are in the report in front of you. The 14 suburban submarkets show an average vacancy rate of 3.3%, while the 6 urban submarkets show an average vacancy rate of 4.3%. This results in an overall vacancy rate of about 3.6% across the entire metro. Jumping over to the data from CoStar, pretty similar in terms of vacancy rates, but I want to highlight here is this dramatic drop in vacancies that we saw starting in early 2021. We saw about 150 to 200 basis point drop in vacancies, and we actually absorbed 10,000 units in 2021. Just an incredible number. As Jerry mentioned, our average absorption rate is typically about 5,000 to 7,000 new units. There's a few reasons for this drop, but the major driver was that household formation. If you're interested in this, I recommend that you read Josh Lehner's article included in the report in front of you. So moving over towards rent, this slide highlights the submarkets with the highest rent growth and the lowest rent growth across the metro area. Overall, the survey shows rent growth was up about 6.5% year over year. Moving on to data from CoStar, they showed about a 9% year-over-year rent increase during 2021, and they show us at about 5.5% right now. Just during my inspections in the past, maybe 60 days or so, I talk with managers, I talk with owners, and I get a sense that the market has softened, just based on the recent increases in rates and some of the recent economic forecasts. And what's fascinating to me is I pulled this chart from CoStar. I originally pulled it last week, and they were forecasting future rent increases in the coming years, starting about 6% and going down to about 4% over the next 3 years. I pulled the data yesterday, and over the weekend, they actually revised their forecast down. Current rent increases, they're forecasting about 4.5% for the year ahead, moving towards about 2.5% over the next 3 years. So CoStar is a huge company. They own a number of marketing websites, including apartments.com, and they're actually able to track the daily asking rent. If you have access to CoStar, this is a fascinating data point here. So they're tracking this in real time for actual units market for rent. Portland is a cyclical market. We do tend to show increases in rents during the spring and summer, then we typically pull back in the fall and winter. But in late July, early August, daily asking rent did start to decline. Again, this is not typical of the market, and this is the 1 year view. But when I pull it back to the 3-year view, or 5-year view, you can really see the cyclical nature of rents. But you can see that the decline in year-to-date 2022 is a bit steeper than previous declines, and this decline will likely continue through the balance of 2022 and into early 2023. We typically see rents start to increase again around January or February. So while asking rents have pulled back, keep in mind how quickly we've climbed. It took us 3 years to go from $1.60 a square foot to $1.70 a square foot, but it took us only 18 months to go from $1.70 a square foot to $1.95 a square foot. So while we have pulled back, I don't think it's that unexpected, given how quickly we've increased our rents in Portland Metro. So concessions are here. They're limited. I'd say they're rare at stable units. I only see concessions really as a property stabilizing as we're trying to reach a stabilized occupancy rate, either to refinance or to sell the property. Moving on to expenses, for years we really haven't had much to say about expenses, but there have been some changes. For any of you who follow it closely, you'll know that yesterday Multnomah County announced their new property taxes. You can find it at the website here. I surveyed about 8 to 10 apartments, and I'm happy to announce that taxes are up 1.7% over the past year. I think for any of you who've owned apartments, this is a welcome relief, given that taxes have increased about 6 to 9% over the past 2 or 3 years. Washington County was up about 2 to 4% based on your specific location. Clackamas County was up about 3 to 7%. In terms of other expenses, repair and maintenance, we've definitely seen increases in material costs and labor costs. But I think the more concerning thing for owners and managers is just the delay, the continued delay in materials and the delay in getting vendors into units. We're having a lot of trouble, or I'm hearing about a lot of trouble of scheduling vendors to get in just for simple flooring replacements, countertop replacements, and this ends up resulting in units that sit empty for a longer period of time, not even marketed for rent. So I hope that this improves in the coming year. Other expenses have definitely increased, but it's more been with the pace of inflation. So moving on to apartment sales. Before I dive into sales, I kind of want to set the stage a little bit. So this is the 30-year, this is the average 30-year mortgage rate. We had a major run-up in year-to-date, and it's hard to believe, but as of January 1st of 22, we sat at an average mortgage rate of 3.11%. Today, that's about 6.92%. If you're not shopping for a house right now, you may not understand how this impacts you, but if your budget was $2,500 a month to pay for a mortgage, your max price in January would have been $585,000. Your max price today is $375,000. A $200,000 drop in your budget for housing. So as the previous speakers mentioned, this will probably keep some of those, hoping to be homeowners, keep them in the rental units for a longer period of time. So as I go through year-to-date 2022 sales, keep in mind that nearly all closed sales for year-to-date obtained financing during this period highlighted in red. We're now outside this period. Interest rates have increased significantly. Most of the forecasts coming out have been pretty pessimistic, a lot of talk of recession, so I just don't think that the fourth quarter sales are going to reflect what happened in the previous 3 quarters. So I have 2 ways of looking at sales. I like to look at dollar volume and then number of transactions. The blue bars are going to be dollar volume and the red is number of transactions. Through September, we're on track for 233 sales, totaling $2.8 billion. This is going to be well below 2021, but more in line with 2015 to 2020. 2021 was this unique intersection of incredibly low rates, tons of equity, some pent-up demand from investors who were on the sideline in 2020. So I just don't think it's fair to compare anything to 2021. I'm sure this record will stand for years to come as the most active year ever for apartment construction, or for apartment sales. So after discussing this record level activity, I don't think it's a big surprise to any of us that values are at all-time highs. The median price per unit is up 9% in year-to-date to a median price per unit of $209,000 per unit. Median price per square foot is up 13% to $253 a square foot. I wanted to pull out just a few market segments to see how certain unit types are performing. This is for new units. This is just units built after 2010 across the entire 4-county metro area. And it's a bit surprising here, but we basically see no significant value increases in new units since about 2016. Some of the median price per unit is being held down by a lot of 15 to 19 unit buildings, small units, lots of studios, lots of 1-bedrooms. That's kind of held some of these median price per unit down, but I find it fascinating that really just seen very little increases in value in this market. For a number of years, and it only intensified under COVID, is investors chasing well-located suburban properties. These have bigger units, more parking, lower density, a few more creature comforts, more ability to work from home, but it's also followed kind of where tenants have shifted. Prices have more or less doubled since 2016, and they're up 25% in year-to-date. On the flip side, this is City of Portland. We've seen modest value increases in recent years. Prices are up about 25% since 2017. For any of you doing the math, that's averaging about 4.2% per year. With the interest rate changes, happening so fast, a lot of questions I get is, what's happened to the market? Are we currently heading down? Where have prices gone? And so I pulled the data. I pulled everything I possibly could, quarterly, monthly, weekly, and I just don't think there's enough data to really clearly state whether prices have increased, prices have decreased, or they remain level. This is the number of transactions, cap rate, median price per square foot, and per unit since 2020 or since 2021. Transactions are obviously down, but really they had nowhere to go but down. Cap rate stable, median price per unit, and average price per unit. There's a lot of noise in there. I'm not sure we can say for certain which way prices have gone. So given the rising interest rate, I think cap rate increases are a real concern. Nobody wants to talk about them, but it's a real concern for a lot of owners and investors moving forward. The benchmark that we typically look at is the 10-year Treasury, and then we look at the spread between cap rates and Treasuries. So currently we sit at about 4.0% at the 10-year Treasury. This chart shows what's happened over the past year on Treasuries. And this actually shows, so the dark blue, the lower line is going to be the 10-year Treasury, and the upper line is going to be the cap rate. And in between those two lines, we call that the spread. And the spread is generally about 200 to 400 basis points. The average is about 270 over the past 20 years. When this chart was made, the spread was 170, but this was back in May. So if I put in where Treasury rates are now at just under 4%, that spread's going to be less than 100 basis points and approaching the lowest level in close to 40 years. So where do we go from here? I reviewed countless forecasts, but unless it was written in the past 4 weeks, the information is no longer relevant. A lot of these forecasts started with, assuming that Treasury rates don't exceed 3%, or assuming interest rates don't exceed 6%, and we've blown by all those current benchmarks. So it's really tough to tell where cap rates are going right now, but I relied on a few people a lot smarter than me with a lot more data. CBRE is forecasting a 10 basis point increase in cap rates by the end of the year, increasing up to 70 basis points over the next 3 years in a severe downside scenario. Fannie Mae is calling for a cap rate increase of 30 basis points by the end of the year. Freddie Mac is 20 to 30 basis points by the end of the year. But again, all these scenarios were based on the assumption of lower Treasury rates. So I'm not sure how reliable they are now, but those are their forecasts. But I think it's important to keep in mind that cap rates are sticky. They take months to move, unlike a Treasury, that can move in just a matter of days. So I think, if we're going to see increased cap rates, it's going to be in a scenario where we have sustained higher Treasury rates, and that's the most likely scenario where we're going to see increased cap rates. So forecasts, I'm not interested in giving everybody some time. I'm not going to read through all these. But I think in general, we're expecting fundamentals to remain strong, though there are serious concerns regarding the direction of both interest rates and overall capitalization rates.